Today on the Wealth and Wisdom podcast, I've got a new partner in crime with me for the week, and we are looking at a market that's sending us some important signals as we head into year end. Bond yields continue to fall, volatility remains elevated, and we're seeing a noticeable rotation into some more defensive and high quality parts of the market. We're going to break down the latest macro data and what it's telling us, why certain sectors are holding up better than others, and what investors should be watching in the weeks ahead. And for our planning topic, we're going to dive into something we've been seeing a lot lately, RSUs, or restricted stock units. So make sure you hang out until the end. We'll walk through how they're taxed, how concentration risk can come through and what it can create, and how to approach them wisely from a stewardship perspective. So let's get into it.
Yeah, welcome to the Wealth and Wisdom podcast where intentional planning meets eternal perspective. And so this is November 24th, 2025, and we are glad you guys are here. And as Cole mentioned, I am Andy Ferguson. Brian is taking the week off for Thanksgiving. I'm joined by Cole Leonida, and we're part of John Moore Associates. Let's start with a quick look at the macroeconomic data and the situation right now. Cole, what are we seeing in the economy?
Yeah, well, we had about a 6 week stretch where we didn't get any data, Andy, and now it's starting to come out, and we're starting to get scheduled when the data might come out in the future. So we learned that the Bureau of Labor and Statistics is going to skip the October non-farm payrolls, or the jobs numbers that everybody eagerly awaits. So that's kind of noteworthy, that it's going to be like November or October never actually happened. We're just going to skip straight to November, and we are expecting that data in the middle of December. We'll get the jobs numbers, the non-farm payrolls, December 16th, and we're going to get the CPI numbers on December 18th. That is conspicuously after the Fed meeting in December, where everyone is not quite sure what they're going to do with interest rates. In fact, last week, market expectations in the bond market were all over the place. Andy, what was the week expectations? What did that look like last week for what they thought the Fed was going to do?
Yeah, so as far as those expectations, it's kind of been a bit of a roller coaster. It started off a few weeks ago at 100% probability that they were going to cut rates, and then it dropped to 60%, down to then 30%, and then after last week with the labor numbers coming in, that now it's up to 70% probability that there'll be a rate cut. And so ultimately, who knows what's going to happen with that? I think with the jobs numbers, ultimately, those came in better than expected, but what has a lot of people concerned is the revision for August specifically is now showing a retraction of jobs by 4,000. And then that is actually coinciding with the more private numbers from ADP as well. So there's what we're seeing is folks are concerned about the labor market, and they're thinking that now is going to bleed into the Fed decision.
Yeah, I know we brought that up. That said the poor labor numbers. In fact, unemployment has ticked up to 4.4%. That's the highest we've seen in about 4 years. And that lends itself towards the Fed cutting rates. And we had just a dynamite drop in from Greg in our investment committee. He said, yeah, they're going to cut rates if they don't care about inflation. And I thought it was really interesting because we've been talking about this. Brian and I have been talking about it for seemingly months now, this kind of competing data where inflation's kind of trending the wrong way, unemployment's trending the wrong way, but the mandate for the Fed is they're competing in what the Fed action should be. And I think that was exemplified last week with what you said. It went from 100 to 60 to 30 to 70 on the probability of rate cut by the end of the year. And they're going to be kind of going in blindfolded because they're not actually getting any of the pertinent data to make a decision. And yet everybody's trying to figure out what they're going to do in December. And even within that, the Fed presidents are diverging on what they think they should do. Should they cut? Should they hike? Should they do two cuts? Who knows? Bob Dahl said it best. This is just a sign that no one has any idea what's going to happen with rates.
Right.
So with that, I think it might be good to shift into what we're seeing in the market, where we are relative to our measure of long-term trend. Andy, do you want to talk a little bit about what we're seeing in the market and maybe some of that rotation that we've seen over the last few weeks?
Yeah, so we saw a pullback in the market last week, and a lot of that, big tech companies coming out with their earnings. So there's a little bit of exuberance there, and then a pullback the next day. And I think part of that is realizing that the market has already priced in these earnings projections for those companies in particular. So we saw the market pull back. We're still above the long-term trend by 9%. So again, as we've been telling people, as the market as a whole, that is not bubble territory. Now, there could be certain segments in the market, especially in that AI sector, that people are saying this very well could be a bubble, and I think there's some warranting of that, just given high valuations and the way the AI sector is looking right now. However, the market as a whole, we've been seeing some shifts. We're starting to see the growth in value, which had a divergence, a pretty big divergence, and now it's starting to get closer to where those year-to-date returns are looking almost similar. There's now that's getting a little tighter there as well. So yeah, rotation in the market. Still, those smaller companies, they got hit last week, probably harder than the broader market and those large companies as a whole. So yeah, a lot going on there as far as the market goes.
Yeah, I think what was really interesting is, over the last month or so, healthcare has done really well, whereas tech has kind of lagged. We've seen some of the high beta stocks struggle, and high beta means they're highly correlated with the market, or they're going to move more than the market. So the high beta stocks have not done particularly well relative to the low beta stocks. Companies with historically low volatility are doing better. Companies with low leverage, strong free cash flow, all those kinds of companies, those stronger balance sheets have been doing well, which makes sense because volatility is ticking up. So people generally go towards what they see as safer investments, safer on the margin, going from, a growth stock to maybe a more value oriented stock. It's been a strong reminder. Brian and I have talked about this it seems like we talk about it every time, is diversification. It's not that risk is bad, but using diversification to try to spread out those eggs, not all in that one big large cap tech basket. We're continually reminded of that. Now, we had a really good Kingdom Advisor meeting last week. We have a study group that we host. Kingdom Advisors does a great job providing us with content. Andy, would you give a little bit of a breakdown? We talked about the theology of investing, kind of spreading out risk and doing good with your money. Would you give a quick Cliff's Notes of that?
Yeah, the theology of investing, it was a really good overall month, and as far as just the topic of conversation and the encouragement there was to look at our investing from a biblical perspective, that we are, one, stewards of what God has given us, and that's really important, and that we are designed to produce, to cultivate, to to grow what God has given us, and we see that very evidently in the parable of the talents that Jesus taught. And so this underpinning of our theology, our study of God, our understanding of God, and who we are as people should bleed into the way that we think about investing. And so investing should be something that we focus on that is for the greater good of humanity, for example. Not just avoiding the bad companies. That's easy, is what I like to say from an overall Christian perspective. It's very easy to avoid the bad companies. But what about the companies that are promoting human flourishing? And so thinking about that as far as what you're invested in, remembering that as an investor in a company, when you own stock, you are responsible for all of the business activities of that company, which is different than being a consumer of within a company. So you could go into a store and as a consumer make decisions. I'm going to buy this and not this, and that is different than actually owning the company that may be doing things that don't align with your overall values. And so it's not designed to be a legalistic thing, but to ultimately let your theology drive your action, your behavior, and that's really important, especially when it comes to investing.
Yeah, and it's values, it's your theology, your beliefs that are driving your stewardship and your spending, your use of debt, whether or not you keep cash available, but also how you invest your money. Are you investing for good or not? Are you screening the bad ones out? Are you seeking out good ones? So really interesting. We've got a video coming out as well on biblically responsible investing that really I think encapsulates that well. Maybe we'll link that in the notes here. But as far as taking risk goes, we've talked about RSUs. I talked about it in the intro. We've talked about RSUs with lots of clients recently. We've seen some big S&P 500 companies, clients that work for those employers coming in saying, "Hey, I've got all these RSUs. What do I do with them?" And we've got some that the company stock has kind of hockey sticked and it's gone way up, and some that kind of gone like this, and some that have gone like this. And there's different strategies for different stocks and different profiles on those stocks. But the key thing here is to understand that when your employment is wrapped up with one particular company, and then you've also got a high amount of your invested dollars wrapped up in the price movement of that particular company, not only are you concentrated with your investments, but you're also concentrated with your livelihood, with your income. That is often lost with people, and concentration is a way that you can build wealth and build it rapidly. It's kind of pushing those eggs into one basket. It's more of a gamble, a calculated risk, if you will. But we've got some folks that they've experienced the uptick. And so now they're thinking, what do I do with my RSUs? I'm still working here. What do I do? Well, we want to give a couple of basic ideas. Everybody's situation's different. We'll caveat that. Andy, one of the things we're doing, I'm thinking about one where the hockey stick on the stock, right? And he's going to have some really high income years. Well, actually, let me back up. RSUs, you get them granted at one date, and then over years they will vest. They become yours. They're no longer stock units. It's actual stock that you own. And when they vest, that is like you bought them at that point, and they're taxed as ordinary income upon vesting.
Right.
So if you see that you've got vestings that are worth a lot and they're coming up this year or next year, look out. There's a tax burden on the horizon, and you can kind of predict that. If the stock price has gone up, you've got a big tax burden. So for somebody who has big vestings coming up, what are some things that they could do maybe on the charitable front to try to offset that big income ramp?
Yeah, this is a conversation I'm going to have with someone here soon about their RSU specifically. So once they're vested, then you determine at what point you want to sell those shares, which is ultimately a capital gain, which can be taxed at your ordinary income tax rate if it's sold within a year, or it can be at the capital gains rate. So one of the things, as far as the client I'm talking with, they have held their shares for over that 1 year time frame, and actually they have a pretty substantial tax hit this year, just due to some planning that they've been doing. And so what we're going to suggest is actually giving those appreciated shares that are long term to a donor advised fund, and that's going to allow them to gift the stock this year, which is where they need the tax deduction. But then it's funny how God works. It's almost exactly the amount that they give every single year to their church. And so we're going to pre-fund through the donor advised fund the giving, the tithing that they do for next year with those shares of stock. So I think it's going to be an effective plan that then frees up some cash flow for some additional savings or some other debt pay down if they want to do that. And so I'm pretty excited to offer that as a solution for them, because I think it's going to be really beneficial in several different ways.
Yeah, those concentrated positions, if you do get a run up, can be great giving candidates, which, if you've got a big income year, whether it be from some of the planning this particular client did, or it's just you've got big vestings in your RSUs because they continually vest. They can be monthly, quarterly, semi-annually, annually even. If you're getting a big vesting, it's going to be really valuable. Giving some of those ones that you've held for the long term, those long-term appreciated ones, to something like a donor advised fund can be super duper helpful. That's a technical financial term, super duper.
Yeah.
Um, One thing that we do with a lot of folks is when they get those vestings and the stock then corrects, it goes down, it's down 15, 20%. A lot of people think if I don't do anything with it, I need to hold it for a year. Well, that's not true. If it goes down, if something happens short term on the stock, that's a great opportunity to create a tax asset, sell the vested stock, even though it's short term, sell it at a loss, realize that, and then diversify into something else. That can be a really good thing. People feel bad about selling low, but it can be a really nice offset because, in all likelihood, with some of that stock at some point, you're going to have capital gains that you're going to need to realize to get out of the stock that's already vested. So creating those tax assets when you can be a really good thing. One of my favorite strategies, Andy, that I think we can end here, and then maybe you can sum us up, is if you've got someone who walks in with RSUs, if you have RSUs as someone who's working for, S&P 500 traded company, if you've got shares that are long term, think about gifting. Think about gifting, or at least wait until they're long term and then sell them at the long term capital gains rate. If you have losses anywhere in one of those concentrated positions, take advantage, sell those tax losses. That can be a really valuable thing for you. And then my favorite thing to do, unless you have some really compelling reason that you want to stay concentrated and you're going to hang on to these stock positions for a long term, sell as soon as they vest. Just sell on vesting.
Yep.
And that way you can make sure that you take care of your taxes. You don't have to worry about the long or short term ups or downs on capital gains or losses, but you can then diversify. Yes, there's no way to avoid the ordinary income you're going to realize unless you give something away and get a charitable deduction. But selling and not having to worry about the fluctuations of the stock, because in all likelihood, you've got some that are already vested, you're participating. You've also got some that are unvested, you're participating. And if you're still working there, you're probably still getting grants. So you're getting even more over time. So trying to diversify out is one of our primary recommendations, though we do get pushback if someone walks in, they've got, hey, I'm getting RSUs from NVIDIA. They may not like the idea to sell ever because they think it's going to go to the moon, but stranger things have happened. Stocks have gone down, even big companies. So just being wary about the risk you're taking, and being wise about that risk and where you're taking that concentration risk. So I think we about captured it. You want to sum us up here, Andy?
Yeah, absolutely. I think the big takeaway, just going back to the current state of the market and the concentration of AI and tech stocks that we're seeing right now, in conjunction to this conversation that we're having about with RSUs. And so, actually, I read this morning, I was reading an article, and he said the danger is not AI itself; it's investor behavior and abandoning discipline. And I thought that was really important, and that really set in my heart of like, okay, this is the way in which we need to encourage our clients that AI is not the problem. RSUs and owning a bunch of company stock is not the problem, but we cannot abandon discipline. And we got to go back to those fundamentals of investing. Again, we'll say this until our faces turn blue, right, Cole? That diversification is key. And of course, we're going to encourage people to focus on generosity when you can. So I think that's the big takeaway.
Yeah, and that's great. So we'll wrap up there. Andy, thanks for helping us out today. Thanks for joining us, and thank you all for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's conversation helpful, please like the video, subscribe to the channel, and share it with someone else who might benefit. For more resources and timely insights just like this, visit our insights page at johnmoore.com, where we regularly share articles, videos, and tools to help you steward wisely. We look forward to seeing you all next week, and have a happy Thanksgiving.